Good afternoon, everyone. Welcome to our Market Insights August edition. I'm Matt Gordillo, partner and financial advisor, Park Edge Advisors. I'm joined by Rich Lowry, who's partner and chief investment officer at Park Edge, as well as Gavin Gowecki, our portfolio manager. Welcome, gentlemen.
Hey, Matt.
Before we begin, as always, let's get a word from our sponsors. Okay, very good there, guys. Well, welcome back, and summer's flying by, and we're getting back to school. And for a lot of us for next week, and markets certainly have been interesting here in the last few weeks, and as well as the economy. And so, why don't we start with you, Gavin, like we always do, and touch base with where we left off last month, and kind of review of our top-down approach here.
Sure. Yeah, and let's pull up our a clip from August Market Insights, where we want to touch on where we left off from last month, as well as one of the new features we have in this publication. So, we started August in a correction for large cap growth stocks, most noticeably, but really the stock market kind of broadly, and we called that out as a potential in July. We could talk about the Bank of Japan briefly, or we can talk about different things. But really, we started this month in a more risk-off, quad 4 deflation kind of stance, and where we are now, I think Rich will get into our thinking on that. But as you can see, we said, hey, this is a correction in risk assets, and we have to judge whether it's more of a short-term correction or a longer-lasting one. So that's where we left off from last month. And what we wanted to just show you here, and Rich could talk to this further, but this 3 to 12-month outlook, you could see the way you would read this is for August 2024, we have an offensive long stance for equities broadly. And then from there, the 3 to 12-month outlook is neutral. So when you bring those two together, you would say it's not favorable. So it's not the most bullish we could be, but it is still bullish, right? So that's kind of how you would put those two things together. Does that make sense, I guess, for viewers?
I think so.
Yeah, and the 3 to 12-month outlook is just based on, a lot of the bottom-up economic data, where we're looking at both real economy variables like, growth, inflation, corporate profits, employment, fiscal policy, but we're also looking at financial market variables like liquidity, credit, positioning, and the amalgamation of that, adds up to either favorable, unfavorable, or neutral. We used to try to capture the bottom-up economic data on the bottom of this report, and we moved it to the top where we think, so we took it out of the box in the lower right, and put that up top because we think it's more valuable, like Gavin said, offensive long with the neutral outlook. If that were a favorable 3 to 12-month outlook, and we had a quad regime that was favorable, the pullbacks like we're seeing now are ones that should be bought. But relative to an offensive long position now, a neutral 3 to 12-month outlook, just looking at bottom-up economic data, and a quad regime that shows markets are behaving more like quad 4 than anything, that bears caution. I would add that the sell-off started in July, and in the July Market Insights, we called out behavior of the yen, and will it bring about a policy response from the Bank of Japan? That certainly happened, and you may be hearing a lot about the so-called yen carry trade. And just without getting in the weeds, I mean, basically what that means is that investors, either local Japanese investors that have faced zero interest rates for 2 or 3 decades, and institutional investors that can borrow basically in any currency would, borrow denominated in yen and reinvest that in other asset classes that would outperform, the yield on in Japan. And the first leg of that trade is a short position in the yen. I mean, you're basically selling yen to buy dollars, and then you're reinvesting the dollars in something more productive. And that has been going on so long. But now, for the first time, inflation in Japan has taken off. For the first time in decades, the Bank of Japan is raising rates. They surprised markets and raised well above what markets were pricing in. That set off this chain reaction where the yen started strengthening. It put pressure on all these positions that start out, being short yen. So that was kind of a basic deleveraging that started in July, carried into August. August 3rd, you had non-farm payrolls that came out that were kind of glaringly weak. And that shifted the focus to, okay, now the Fed is going to have to cut. It's really the first report that missed expectations in a long time. And it kind of recentered the debate that if employment is that weak, is a recession back in play? And the market, the bond market is pricing as if we are going to have a recession based on how many cuts they're priced in. Stock market is not really worried about recession. It's trading primarily based off of how many cuts we're going to get. And that growth is resilient. We've had a couple of key economic reports come out since then that confirm that the economy is still resilient. So we have this setup where, bonds are starting to look attractive for the first time in a long time, but pricing assumes that we're going to have a recession that's going to cause the Fed to cut about 7 times between now and next year. And that amount of cuts you would only really expect to see in a recessionary environment. And the stock market is trading as if recession is not, the concern. So, when you put together the bottom-up economic outlook based on the economic data, that does look favorable for bonds, neutral for equities. And then in terms of the current market regime, that leans quad 4. Gavin, if you want to slide down to the second page of Market Insights. So coming into the month, quad 4 had a slight lead on quad 1. Numbers as of this morning would be 43% quad 4, 35% quad 1. Main takeaway from that is that's on the left-hand side of the distribution. So if you start in the upper left, quad 1 is growth and inflation slowing. You move to the upper right, growth and inflation, growth accelerating, inflation slowing in quad 1. Quad 2 is both accelerating. Lower right, quad 3 is growth is slowing, inflation accelerating. And quad 4 is both growth and inflation slowing. So the fact that you have, as of today, 78% that's either in quad 1 or quad 4, markets are pretty much concluding that inflation isn't the main problem. The real question from here is growth going to slow or not? And Gavin, if you want to pull up, we'll kind of walk through how we come up with those figures. So no one's going to be able to read this. We had to shrink it down so much just to fit it on the page. But to the left-hand side, the green column headings are various global equity indices. And you can see those are mostly neutral. The red column headings are volatility, and those did go through a bout of volatility that most people will recall of the past few weeks. Those have settled down and are back to neutral. Then you have commodities that are neutral to bearish. You have currencies, followed by global interest rates, credit spreads, and the reason we focus on this is that other global markets are going to be more sensitive to the rate of change of growth and inflation than the stock market is. The rationale behind that is that the stock market is dominated by flows that start with a payroll deduction that go into a 401k, where roughly 60% get parked in a target date fund where they buy the same thing every month. So there's less sensitivity of the stock market to pending inflections in growth and inflation that these other markets pick up. So, global interest rates, global credit spreads are more sensitive to changes in growth and inflation, as are commodities, as are foreign currencies. So if you can pay attention to what's going on across all these markets and characterize the behavior across all these markets, it allows you to form an opinion as to the favorability of the stock market. There's a lot of neutral signals. The bottom row would be this morning, and there's a lot of neutral signals. So the more neutral signals that are on the page, the lower the conviction score. That means a lot of markets aren't registering a signal one way or the other. So even though quad 4 is in the lead, it's not a lot to be worried about, primarily because the conviction score is so low. But as these other markets begin to make up their mind, we'll find out, are things going to resolve in a way where some of these neutrals turn into either green checks or red X's in a way where we move into quad 1. That would be obviously more bullish. Or do we start picking up more and more quad 4 signals? In which case that would tell us that the correction that we've been through in the pickup in volatility may be around a little bit longer.
Well, that's very helpful, Rich, and very in depth. I'm certainly glad our clients have guys like you looking at all the details and all aspects of the globe for opportunities and risks. Often, they say you can only prepare for so many risks, and true risk is the thing you're not aware of. You just don't know what's going to come next. But
well, there's a saying that risk happens slowly, then all at once.
Right. And I feel like we've been down this road before with mixed signals, and nothing more mixed than a mix between quad 1 and quad 4. We also, we get clients that ask, hey, what quad do you think we're in? And so, quad 1 is a very bullish quadrant, and quad 4 can be very bearish. So, still continuing this possibility of a phase transition, as you use that term, and mixed signals, and certainly we've seen one thing I think I've seen for sure is the markets and investors love to overreact to Fed speak and predicting where the Feds are going to do with their interest rates. Before the year started, we were talking about 7 rate cuts being priced in, and seemed like 30 days later that we're all off the table, and here we are again. So, I guess we'll find out if bad news is bad news for the economy, or if bad news is good news, which meant lower interest rates as we are coming out of 2022 and 2023 after the immediate increase in rates. So all a lot to follow and digest, but glad you're here to help us through those things.
Yeah, we've had kind of this bad news is good news for quite a while, because the focus was on is that going to get the Fed to cut? Now I think it's safe to say that the market's focus, or the Fed's focus, is away from what's happening with inflation, and it's more kind of squarely centered on what's happened with employment. And that kind of relates to this transition where bad news is bad news. Bad news meaning if employment weakens from here, if that non-farm payroll number was not a fluke, and you see continued weakness in employment, that would be bad news is bad news, because it means a couple things. The employment figures are always the last to go. And all the focus on, are we going into recession or not? Or, all it really boils down to is when does the employment cycle turn down? Because that has a reflexive component to it. Layoffs produce other layoffs, which produce other layoffs. And, that would be bad news is bad news. And it also would indicate that the Fed is way behind the curve. So if employment does continue to weaken from here, that raises the odds of a recession, what is 25 basis point cut going to do?
Right.
What are 3 cuts by the end of the year going to do? Think of how many times they raised rates and how long they kept them. It's not likely that rate cuts, if the employment cycle has begun to turn, it's not likely that rate cuts would do anything, to help that.
Gavin, you had something to add?
I was just going to say, touching on what Rich said before, from like in the seat of looking at these markets every day, the last sentence of this August market insights, I still think this correction is playing out, and it's important to not conflate the correction that started in late July, like Rich said, in equities, I'm talking about in the stock market, with what happened with the Bank of Japan. They ended up happening at the same time, but they're 2 separate potential issues to watch and track. So what we basically had was the beginning of a correction. The Bank of Japan unexpectedly, at least the market thought so, hiked rates at a hike, and that brought a very quick shock of volatility into the market. But here on the 15th, we've seen equities, from that Monday the 5th, on the shock day, just equities up in a straight line. But really, we're just back to where we were prior to the BOJ event risk that ended up unfolding. So I think, that the last sentence here remains true. It's like, let's see how August keeps playing out, and if this is going to indeed be a shorter term correction, or if it turns into something longer into the fall.
Yeah, and the things that we'll track, are right there on the page. If the economic data, weakens from here, it's possible that neutral economic outlook over 3 to 12 months, could turn negative. And either along with that, or more often the market front runs that, we should see it in the bottom part, the market regime probabilities that tell us, aside from what the economic data is saying, how are markets actually behaving. So there are, a couple tools that we use regularly to help us assess that. So like Gavin said, our best case right now is, this is a pullback, it's a correction. It's not the beginning of something really bad, but there are things, that could happen that would lead us to draw a different conclusion, and that would be the 3 to 12 month outlook going unfavorable, and a rising conviction score on that system with all the green checks and red X's that looks like it would be a more decisive quad 4.
Well, gentlemen, thanks for that detailed analysis and outlook. And next month when we meet, we'll be football season will have kicked off, and we'll be rooting for our favorite teams. And we'll see if Park Edge feels that we're moving the ball on offense, or if we should be playing defense with the market. So we'll look forward to that update.
All right, sounds good, Matt.
Okay,
thank you.
Have a good one.